One of the interesting topics we've gotten that risen in a number of conversations recently in our one-to-one is mergers and acquisitions, how to essentially purchase another practice. And Ed and Jamie are well versed in this strategy now. Ed, you've got a good few scars from this strategy, but you've also got a lot of wins and experience to share. So want to peel back some of the layers of the practical steps and the things to consider when looking at an acquisition for the practice as part of the growth strategy. So where should we start with this conversation, Ed? I'd love to hear a little bit of your experience into this area of growth, and then we'll move to Jamie to get some of the nitty-gritty practical steps.
Yeah, sure. Thanks, Brenton. Obviously, to grow your business, there's just, 4 ways to do it. So the low-hanging fruit ones that are the first two, getting more referrals and selling more services to your existing clients. And you can download the monetization sheet from the Wize Vault to help you sell more services to your existing clients. They're the 2 low-hanging fruit, which you should be doing to begin with. But the other 2 ways to grow your business is just digital marketing, doing the marketing side. And the last one is acquisitions and mergers. And this is the topic of today, which is acquisition and mergers, or we call them tuck-ins, but it's predominantly going out there and buying an existing firm. There's advantages and disadvantages of doing that. And let's talk about the advantages first, and then we can talk about the disadvantages. But the advantages is that currently the interest rates are very, very low. So you can get a loan for an interest rate of somewhere between 3.5%, 4%, 4.5% as an interest. Normally, the KPIs, the numbers in an accounting firm is cost of goods sold runs at about 40%. And your fixed overheads runs at about 35%. So your profit, your EBITDA, should run at about 25%. Of course, if you're making 25% EBITDA and it's only costing you 3 or 4% interest, you can do the maths yourself. And you can see that, the profit's going to pay off the loan, not just the interest, but also the principal. Now, with an acquisition, though, the numbers are much better than that. With an acquisition, because your fixed overheads are fairly fixed, so you're not doubling your reception or you're not doubling your fixed overheads, instead of being around 35% like they would in a normal business, it could only sit at about 10%. And if you've got some spare capacity within your existing staff, your cost of goods sold may not be 40%, might be sitting at 30% or even less. So you can actually take out about between 50 to 60% profit, as opposed to your own firm, which is sitting at around 25% profit. So in pure numbers, it makes sense to do so, because often, that profit that's sitting at 50 to 60% goes straight to the bottom line, and it funds the loan itself. And if you structure it correctly, then you don't have to borrow money for the first installment. The second and even the third installment is paid by the profits from the practice itself. So it's funded itself. And within a few years, you could actually, 2 to 3 to 4 years, you could actually pay the loan off with the profit. So it's quite a good strategy moving forward. But there are some downsides. And if you don't do it right, it can actually bite you, because people say to me, I don't want to borrow money. But it's not the loan that's the problem. It's the inability to service the loan that's the problem. So the first thing is, don't be fearful of that, because you're using that loan to buy an asset. So, we're all accountants. We know there's a debit and there's a credit. So as long as there's a debit, which is an asset, you don't mind having a loan, which is a liability, because one offsets the other and you're back to zero. But the real risk is if you stuff it up. And, as I said, it's okay to have a loan as long as you've got an asset offsetting it. But if you stuff it up and you lose that asset, or you lose a portion of that asset, then the worst thing is that you end up with a loan or a debt without an asset against it. And that's where the risk is. So it's important that if you're going to embark on this strategy, that you do it properly and not risk the asset. Because often, I've seen people left with a loan and they've lost half the clients, so they've lost half the asset and they've gone backwards.
Okay. I want to touch on some of the downsides to the strategy and the consequences of going into it ill-equipped or not ready. But before we do that, when should a practice owner consider this strategy? At what point in their journey? Because we do speak to a lot of practice owners who are very eager to get into this area of acquisitions. But, if the house isn't in order or if there's cracks in certain parts of the business, it can lead to fairly problematic circumstances. So when should a practice owner consider this?
Okay, the first thing is if you've already got a lot of existing debt, I wouldn't want to do it if your loan value ratio, your LVR, is more than 50%. So you want to keep your loan value ratio below 50%. And as I said earlier, debt's not the problem, it's the inability to service the debt's the problem. And if your LVR is more than 50%, it actually puts pressure on your serviceability. So that's the first thing. The second thing is make sure your house is in order, because we talk about leveraging good things means one good thing plus one good thing gives 5 good things. But if you don't get your house in order, you can also leverage bad things, which is one bad thing plus one bad thing gives you 5 bad things. And it can actually turn your existing business, which may be going quite well, into a bad business because of the purchase that you've encountered or you've got yourself into. So make sure your house is in order, make sure your team structures are right, make sure your Fab 5 is working well and they're all showing a trend in a positive, going upwards. Clients are happy. You and your senior client managers will return your phone calls to your clients on the same day, and you're not taking 2 or 3 days to respond. Your numbers are looking good, like the Fab 5 is made up of, your turnover's going up, your profits are going up, you're getting more new clients than you're losing. So we tracked it in the Fab 5. And your NPS, your Net Promoter Score, your surveys with your clients are giving you 9 out of 10, 10 out of 10. The clients are rating your service at that level and your staff are happy. So once your KPIs are all in the uptrend, and your LVR is not too high, then at that point you should consider, this strategy. And of course, you've extracted as much as you can from the referral process, from the monetization sheet, and you've got a good, robust marketing strategy going, because even when you buy a firm, they'll scrutinize you. They'll come in and they'll want to know who you are. So you've got to have a good website. You've got to have some good social media going, so there's some credibility within your organization, because when you buy clients, they're at a heightened level of suspicion. They don't know who you are. They don't like being sold, if you like. They're not a commodity, and they're watching you. You've got to win their trust. And winning their trust involves all the above, all the things that I just talked about, having a presence on the social media, having a good website, having a good communication with the clients, having an open communication with them, all the above, to build the trust that's required before they'll start listening to you.
So just on that point, how do you avoid buying a white elephant, as he calls it, white elephant practice, where the clients just leave quickly or you can't accommodate the new team and pricing?
Well, it's in the due diligence. It's always buyer beware, as everyone knows. So you've got to do your due diligence. And when you're doing your due diligence, it's not an exact science, but there's a little bit of a risk, because some of the clients are obviously good clients and they're bad clients. And some of them are older clients. They may only be around for another year. Some may give you 2 or 3 years. So if you're going to give you a year and you've paid $1 per dollar for it, then you've only just got your capital back at best. So all those things are part of your due diligence. So you've got to go into it with your eyes open. You've got to negotiate hard. For example, I bought a firm from a guy that was 73 years old, and birds of a feather flock together. So he had a lot of older clients. In the database was a substantial number of older clients, but also amongst those older clients were self-managed super funds. So, even though they might sell their business, they'll still continue on with their self-managed superannuation fund. So I'll get more than, a few years out of them. So what I did was, with the ones that looked like they're going to sell out in a year, I negotiated 25 cents on a dollar. And my argument to him was that my recovery was 4 times. And if I couldn't get 4 years worth out of it, then it wasn't worth it. And if I could only get 1 year out of it, it was 25 cents on a dollar. If I can get 2 years out of it, it's 50 cents. 3 years is 75 cents, and 4 years was $1 per dollar. So I went through each of the clients and negotiated on that basis. And there's a whole swag of other things that you've got to consider as well. They're just a few.
Okay. No, that's a great point. I think that in itself is worth noting down.